In this month's Economic Update, Kaplan Professional Education's Michael Pollock speaks to an industry economist about the short-term domestic and global economic outlook.
Welcome to Kaplan Professional's monthly economic update. I'm Michael Pollock, and this month we're speaking with Chief Economist at BetaShares, David Bassanese. Thanks for joining us today, David.
Thank you, Michael. It's great to be with you.
Let's firstly take a look at the US economy. What do you see the US dollar doing this year, given the apparent monetary policy divergence between the US and other major economies, coupled with talk that it could already be overvalued?
Look, I don't think it's overvalued yet. If you look at the US dollar in real terms from a longer run perspective, it's actually still a little bit below its long run average, and probably scope to go up as a result. And if you look at the fundamentally the US dollar should go up this year. You've got the US raising rates, no one else is really talking about raising rates. You've got Donald Trump promising fiscal stimulus. You've got a tight labour market, wages picking up. So you would think the US dollar would rise in that environment. My only caution is that everyone is thinking that, and typically when you get such a consensus trade, or a crowded trade as we say, something may come along to change that view. But my base case view is the dollar will continue to grind up from here, and as a result, the Aussie is probably going to grind down. But certainly waiting to see what could change in that scenario.
And with housing expected to come off the boil as rates rise, what do you expect to be the key drivers of the US economy this year?
Look, I think a couple of things. Firstly, a business investment looks to be... basically the OPEC deal, for example, to the extent they've cut back production, it is opening the gate for US oil producers to come back into the picture somewhat. So we're seeing, the rig counts, these sort of things picking up in the US. So a rebound in oil production will help. Consumer spending still looking quite good as well. That's a big chunk of the US economy. So if consumer spending holds up, I think the economy will do quite well as well. So there are good drivers, I think, for the economy going forward. Housing's coming off the boil a little bit. Trade is going to be challenged to the extent the US dollar continues to rise. But the domestic drivers of the economy I think still look pretty good.
Turning to China, David, how likely, in your opinion, is a US-China trade war, and what are the likely outcomes for the Australian economy?
Well, I don't think it's very likely. I think Donald Trump, at the end of the day, he's not going to... he's been a businessman for many years. I don't think he's as silly as people think he may well be. And but what they will do, there will be probably a war of words. To him talking tough with China, and China probably talking tough back, because the other issue is that the Chinese authorities aren't afraid to throw their weight around as well. So I think there'll be political posturing on both sides probably as the year progresses, which will worry markets probably on occasion. But again, I don't think either side will see any sense in a tit-for-tat trade war. If America did impose tariffs, for example, on China, China's going to turn around and do something to the United States, and it's a negative sum game effectively, and they'll basically, or another way of thinking, mutually assured destruction. So they'll stand back from launching their various economic weapons, I think.
What are the likely implications for Australia as China makes the uncertain transition away from an over-reliance on construction and debt?
Look, eventually the implications are that steel demand in China, and as a result iron ore demand will decline, and as a result iron ore prices will probably fall back somewhat further, potentially all the way back to say even $25 a tonne or thereabouts. But that's unlikely to happen anytime soon. I think the transition that we've all been talking about in China is proving more challenging, and it's going to be more longer term and more gradual in nature than probably even the Chinese had hoped for. So the story of 2016 is that China had to rely on domestic demand and industrial sort of production to keep the economy going along, and I don't think that reliance has changed this year. So they'll be still stimulating their economy through these traditional drivers for the foreseeable future.
Looking at Europe, to what extent do you expect market shocks to arise from global anti-establishment sentiment impacting this year's elections in Germany, France and the Netherlands?
Yeah, look, Europe is a potential wildcard this year. I mean, you've got Donald Trump in the US and you've got European elections as two of the wildcards. I mean, it could be quite... At the end of the day, I think no one will see sense in leaving, Euro breakup, I guess, is the ultimate thing that investors are worried about. But, there are going to be a lot of challenging moments, I think, for the markets this year. So the elections... The populist parties in Europe are proving quite popular, so there is a risk of, them taking either Germany or the Netherlands, forming an important part of the new government. But at the end of the day, I don't think anyone's going to have a referendum and vote to leave the EU. So that I guess at the end of the day won't happen.
What do you see as the likely impact of the Brexit saga on growth in Europe this year?
Look, Brexit itself, I don't think has a big impact on the rest of Europe because, the UK, Brexit is more an issue for the UK itself rather than what it will do for the rest of Europe. And in terms of the UK, it's still very uncertain how that's going to play out. It's looking more and more likely that there'll be a so-called hard Brexit where they, basically have a clean cut from the EU and then hope to renegotiate a free trade deal or as what even... undertake the sort of WTO World Trade arrangements, whereby Europe basically has to offer the UK the similar trade preferences that it offers to the rest of the world. And Europe, China, United States are able to trade with Europe pretty effectively without being part of the EU. So I think that's what the UK is looking toward as well. But I think Europe itself, the bigger issue is not so much Brexit, it's really is the rise of the populist parties and the election, political uncertainty they're going to face this year.
And finally to the domestic situation. With the Fed hinting at 3 further rate rises this year and the RBA perhaps cutting further, do you see the Aussie dollar dropping significantly or will it be bolstered by the relatively robust terms of trade?
Yeah, look, on balance, I think the Aussie is probably going to drop further. I wouldn't say significantly. I think it's going to test 70 cents at some point this year. Certainly, if the Fed does follow through with the 3 rate rises, and I think iron ore prices are probably overvalued where they are, so they'll come back a bit, but not by a lot. So you're talking about maybe $45, $50 for an iron ore price, and a narrowing of that interest rate gap should see the Aussie test below 70 cents probably by the end of the year, I think.
Where do you stand on the thesis that low interest rates, domestically and globally, are the new normal, given high rates of government debt to GDP?
Look, I subscribe to that view. I think, but interest rates have been quite low for some time now. US 10-year bond yields, for example, I was just looking at the numbers recently, they've averaged only 3.25% since over the past decade or so, since 2003. They're now around 2.5%. I think they're going to get up to just over 3%. And sort of that is the new normal. Going back to the 1990s, 1980s, you were able to get around a 5% or so yield, but something around the 2.5 to 3.5% level for US 10 years is probably the new normal, and for Australia, probably around say 4% on a 10-year bond versus say 5.5% a decade or so ago. But relative to that, interest rates are still quite low and are still likely to rise. So where they are today is unusually low and unsustainably low. But the where they will average over the next few years will be lower than we've been accustomed to probably 10 or so years previously. That's the reality of low inflation, lower global growth, and as you said, more cautious. Households are more cautious in their spending because they've got a lot higher debt levels now, and so a moderate increase in interest rates seem to have a quicker impact on spending than it has in the past.
And which sectors of the Australian economy do you expect to outperform in 2017?
Look, it's interesting. We had small cap. We had a period where the large caps in Australia both struggled. The resources sector and the banking stocks, for different reasons, struggled, and we've seen a resurgence in them over the last 6 months or so. Or resource stocks pretty much for the past year, and bank stocks more recently. And I think both of those areas are still looking good. The resources sector. Even if iron ore prices come back a little, you've got analysts out there still revising up their earnings outlook for the major miners, so that's going to follow through. And the banking area is what we're seeing with rising bond yields is investors getting out of the so-called bond proxies, as in listed property, telecommunications, utilities, and chasing yield in areas where they're less negatively affected by rising bond yields. And banking stocks is one of those. And the yields available amongst domestic banks are still quite good. So I think the switch of money out of the bond proxies into financials, and I think the financials are probably unfairly beaten up somewhat by the fears of capital raisings over the past year or so, and valuation-wise they got relatively cheap. And they're not as cheap as they were because they've rallied back, but I still think they look a relatively good source of income this year and will prove popular with investors.
Thanks very much for your time today, David.
No worries. Thank you, Michael.